Todd, the financial performance for the first half of financial year 2026 has been nothing short of transformative. We've had a major merger with Brickworks implemented and really strong performance across the portfolio. How would you summarise this growth for shareholders?
Well, I think on any measure, it's been an incredibly successful and strong set of results for the first half. Early on, obviously, we completed the merger with Brickworks, and that has integrated really well and is going to plan. But then if I look at the activity that we did through the first half, it was the busiest period that we've had on record. We did $4.3 billion of transacting activity across purchases and disposals. We've continued to reposition the portfolio in a very thoughtful way to take into account the kind of macro environment we are in. So it's really been something that we've needed to do to prepare ourselves for what we're seeing today.
And across our three key performance indicators, which are to grow the portfolio, grow the cash generation, and manage risk, how would you define it for growth in cash flow?
Well, the financial results speak for themselves. The cash flow increased 15% on a year-on-year basis compared to the first half of 25. If I look at that on a per share basis, that's been a 12.5% increase in the cash that we've generated across the portfolio. That to us is more important than profit. We look at a total return basis, so not just the capital growth of the portfolio, but also the cash flow growth that we see. The other benefit is that cash flow growth is what fuels our dividends, and we've been increasing dividends now for 28 years, so the fact that we were able to increase cash flow again through this more difficult period is something that's been very satisfying.
And that $4.3 billion in portfolio turnover, what should shareholders make of this when you talk about a dynamic approach to risk management?
The higher level of activity is a reflection of the environment that we're in. The more uncertain outlook in the environment requires us to manoeuvre the portfolio into a more defensive stance, increase the level of liquidity, and ensure that we're in a position to act if there is volatility or dislocation. So that activity is really just a defensive mechanism to ensure that we're well positioned to act.
Behind that $4.3 billion of transaction turnover sits a very strong balance sheet.
Yes, and that balance sheet, if you measure it through net asset value at the half, is $13.8 billion. Within that, there's less than $300 million worth of debt. So the level of gearing in the portfolio at the moment is very low. That gives us the flexibility should market conditions turn and we need to access liquidity. We've got about $500 million worth of cash on hand, and we've got a further $1.2 billion of available debt facilities which we can draw on to deploy into opportunities that dislocation may present.
So David, the merger with Brickworks, while that helped strengthen the balance sheet, it unlocked greater value for shareholders. Can you please explain?
Sure, and that value's in a number of different ways. One, it simplified the reporting. The second important element to the merger was the ability and the approval that we received to reset all of the tax cost bases of all of the assets in the old Sols Group and the old Brickworks Group up to their market value. So that got rid of a lot of latent capital gains tax liabilities that sat within the portfolio. So we can now transact that portfolio with much less tax friction than we would have in the past. Importantly as well, all of the franking credits that both Brickworks and Sols had prior to the merger have been retained, and together that today is well over $1.1 billion unused franking credits. The board has declared a 48-cent per share dividend, fully franked, today, which will get paid in May.
The environment is permanently uncertain at this point. How is the portfolio positioned right now, and where are your key priorities?
The portfolio has always had a bias towards more defensive qualities that protect capital on the downside. I would say we're accelerating our view around those things, which means that we are firstly looking for more liquidity across the portfolio, the ability to move into new areas where it's required. Secondly, to move into more defensive assets and more defensive investments that will withstand any volatility. And thirdly, ensuring that we have the liquidity and the bravery to be able to act where we see good opportunities, and we can be contrarian and take advantage of situations where risk is mispriced or assets have been oversold, and move into those in a more decisive way.
Todd Barlow, thank you for your time today.
Thank you.